All right. What's going on, everybody? We are live. If you're watching the replay of this, go ahead and click on that replay live chat button. That way you can see all the questions that are coming in real time. Welcome to everybody joining live. Go ahead and start throwing questions in the chat. And also let me know if you can see and hear me okay, just so I know my equipment is working. Looks like we're got some people joining now. Again, let me know if you can see and hear me okay. All right. Thoughts on GARLF? What is that? GARLF. That is Roxmore Resources. Okay, guys. Let me share with you my screen. Keep in mind when I do like a screen share, that's typically for some reason when everybody says that it glitches out. So I think it's just Chrome, the browser that I use when I do these streams. For some reason, sometimes looks like the connection cuts out when I do a screen share. But 1,000 shares up to like 100,000 shares a day, and it's trading at $1.43. So somebody with a $200,000 account can be buying and selling these shares, making the price spike and fall. It's like literally anybody. There's no volume. The market cap is 70 million on this thing, so there's no fundamental analysis, no technical analysis. I mean, that you can do on this, and then even the fundamentals. It's like, all right, well, how do you know? I mean, yes, it's over the counter, so it's not even listed on an exchange. So something like this, unless you are extremely confident that the numbers that you're looking at are accurate and real, and you can verify them somehow, it's like that's a wild gamble. Okay, next question. Greetings from San Diego. Hope your weather is good right now. I love the sunshine. Norway, probably don't have much sunshine in Norway. All right, let's see. Has anyone ever said you look like Poldark? Maybe, but not to my memory, because I don't know what Poldark or who Poldark is. Tell us about Oracle. I need to do a deep dive into Oracle. I'm not sure. Looks like right now, as far as I know, their credit default swaps are getting priced really expensive, which means that there's at least some expectation in the market that they might be necessary, which means somebody is expecting or just wanting to hedge against a default there. So could have some trouble there. Thoughts on liquidity coming to the markets. What real impact will be and when we expect to drive markets upwards meaningfully? Q1, Q2. What happens till then? Is a crash further pending? In my best estimation with what's been going on over the last couple of weeks, the last month or so, is that the downside for now is done. When you see extreme levels of fear, when you see extreme levels of oversold from different technical indicators, when you see Warren Buffett deploying money into companies like Google that are at all-time highs, and in the spaces that everybody is fearful about, those are not indications of tops. Those are typically indications of short-term bottoms. So my best guess is that the short-term volatility or the small little the crash, the little drawdown, the correction that we've had so far is either at its end or near its end. And I think we'll start to slowly grind higher from here. When you look over the long term, markets climb a wall of worry. And that's what we have right now. That's why they say markets take the escalator up and the elevator down. They slowly grind higher, looking kind of like stair steps. And then when they go down, it's just a straight shot down. But overall, that's the pattern that they move when they're grinding higher. And the liquidity that we're about to see, the increase in liquidity over the next couple of quarters, is going to add to that. We're not going to see anything insane. Like we're not going to see probably any sort of a crazy like blow off top, or I don't think we're close to anything like euphoria, that type of thing, because we're not getting the type of liquidity injection that we need for that. We're not going to get the $3 trillion of printing and QE and government spending that through PPP loans and stimulus checks and all that. Um, but we're going to get a just a nice general expansion that will lead to have some upward pressure on asset prices. That's going to come from QT ending. That's going to come from bank deregulation. It's going to come from lower interest rates. It's going to come from continued fiscal spending increasing. It's happening globally as well. It's not just the U.S. So we've got a nice little instead of one giant fire hose of liquidity being turned on, we've got a bunch of little hose spigots being turned on. So over the next couple of quarters I'm not thinking it's going to be a quick giant spike. All right. JG Lab, you said a couple times that I'm frozen and muted. Can anybody else confirm that, or is that maybe just on his end? Okay. All right. Let's see. Next question. Where were we? Do you think there's a market rotation in small caps like IWM and equal weight S&P 500? I don't know about equal. Yeah, not necessarily a market rotation, because I still think we'll probably see some of the best growth out of some of the largest names. Like we still have really good valuations for companies like Amazon and Google, even though their market caps are large. And even though Google's at an all-time high, and even though you know, it's still rising higher, it's like I think the PE is only like 32 or something like that. So, I think we'll still get really good growth out of some of the the mega caps. But IWM is looking like it's prepped for a really nice big rally as well. I could be wrong about that, but I am long IWM and small caps. Thanks for hosting these. Much appreciated. Yep, I'll keep on doing these as long as you guys keep on showing up and asking questions and telling me you like them. The day you tell me that you don't want me to do this anymore, I won't do it anymore. All right. What do you think about Tom Lee's ultra bullish or perma-bull narrative and Ethereum supercycle beginning? Would you agree crypto, Bitcoin, and Ethereum specifically has bottomed? I don't really do any commenting on any cryptocurrency other than Bitcoin, other than saying that I don't like them and I don't touch them. The more I learn about every cryptocurrency, the more I dislike them and the more bearish I get on them long term. The more I learn about Bitcoin, the more I like it and the more bullish I get on it long term. They're different things. Blockchain is monetary technology. All of the analogies that people use for other cryptocurrencies, they fall. They're narratives built for people who have not done the research on what these softwares really are. And I think over the long term they will all trend towards zero, other than Bitcoin. So I am long term bullish on Bitcoin. Short term, I don't really care or have an opinion on what it does. I think there's a good chance that most of the selling for Bitcoin is done now. But I mean, we've seen huge drawdowns way bigger than this in Bitcoin in the past, and it'll probably happen again in the future. When buying rental properties, do you use debt or buy it all in cash? And what net ROI should you be aiming for? This is just me. So I'm not saying this is something that other people should do, but I typically will just put down enough to make sure that the property cash flows. Now I'm also like, that's not the only way to, that's not the only consideration, because if the if the property won't cash flow without you putting, 40 or 50 or 60% down, it's probably not a great property for you to buy as an investment. Um, I'm if you're in the neighborhood of 20 to 30%, in my opinion, that's probably decent. Um, the reason why you want it to cash flow is because you want it to be an asset. You want it to pay for itself. You want it to, at the very least, cover the debt service and the maintenance and the vacancy and the fixes and the repairs. That way, you've got somebody else who is building equity for you. With interest rates where they are right now, and with housing prices where they are right now, you're not going to be picking up properties for extreme cash flow. It's a different world today than we live in, that compared to 10, 15 years ago. Um, and so you're not going to be picking up properties for a really high cash on cash return. At least that's not what I'm finding. And I'm looking in good areas where the house prices are still 150, 160, 180, where they stay rented, good renters markets, good landlord laws. And so the only way that I think you're going to get a really high cash on cash return is if you do Section 8, and you've got to, there's a big learning curve there with what you have to do to those properties and how you have to interact with the government, and then you also have to just morally be okay with being on the receiving end of government transfer payments, being on the receiving end of taxpayer money, which at this point I personally am not. So anyway, that's what I try and do, is pick it up. If I can get it for 20 to 30% down and it's cash flow positive, then that's good enough for me. All right, let's see here. Next question. Where were we? Oh, there we were. Okay. Um, I'm currently trying to secure a mortgage and I'm moving states, and I'm trying to figure out whether to buy down rates or the likelihood to refinance if rates are going to be dropping due to pressure. Um, that it's really a math question, because when you are buying down the rate, you have to look at how much is it costing you versus when is your break even point. So like for instance, if it's going to cost you 10 grand to buy down the rate a certain amount, and that's going to decrease your payment by, let's say, $100 per month. Well, then it's like, okay, well, after a year, that saves me $1,200. So this is going to take me 8.5 years to break even. It's like, okay, well, what are the odds that I might be able to refinance for a little bit lower in that amount of time? Probably pretty good. And if not, I know my income's probably going to go up in that amount of time by more than $100 per month. So you kind of just have to do the math on where the break even is to see if it's worth it to buy down the rate in terms of how long it will take you to break even on that higher cost up front. Any plans to do market open live streams? No. No, and I'll be honest, the reason why is because I haven't other than if a couple of times I've had to catch a flight, um, I don't wake up that early. I haven't woken up that early since I was a broker. I That's literally one of the reasons why I know this sounds so dumb and so like privileged, but that's one of the reasons why I felt on the edge of depression when when I was still working as a broker, because I had to wake up so early. I absolutely despise it. I'm a late person. I go to bed late, sleep in late, work late, like that. I just personally feel better that way. And so no, I don't do anything. I'm not up during that time. So unfortunately, no, I will not be doing market open live streams. Um, all right, let's see. I do not invest in crypto plainly because they don't have intrinsic value. How would you convince me otherwise? People hold Bitcoin because they think others will want to pay more later. Why? Okay, here's the thing that most people don't understand about value. There is no such thing as intrinsic value at all for anything anywhere. Um, Intrinsic value and objective value can be conflated. They're the same thing. In this context, they are. And I know in like financial definitions, when you're looking at things like option contracts, like there are things called intrinsic value. But from the standpoint of like, oh, I don't buy Bitcoin because there's no intrinsic value, or I don't buy um, sand because there's no intrinsic value, or I don't buy oxygen because there's no intrinsic. Like all value is subjective, and the best example of this is like gold. You'd say, okay, well, some people would say gold has an intrinsic value because it has a use value. It's like, okay, well, if you're stranded on an island and you have the choice between a couple bottles of water and some cases of MREs, you would choose that over trillions of dollars worth of gold because to you, there's no use value for it. It is worthless to you. So all value is subjective in the sense that it is people only ascribe value to something if they want it. And there are certain situations in which people want some things and not others, and vice versa. And so we have to do away with this concept of intrinsic value. Nothing has intrinsic value, only subjective value exists. So then you say, okay, well, what is the subjective value that people have traditionally given to gold? Well, it doesn't rust, it doesn't decay, it can't be destroyed. It's easy to identify whether it's real or not. It's easy to identify just because of its color, because of its malleability, its melting point, its weight, and it's relatively scarce. It's hard to produce more of it, and so because of those characteristics, people have found it to be useful as the most saleable good. In other words, if I accumulate this, it's not going to increase or decrease in supply very much. And so I have a good chance of being able to trade it for something else later. And it can store my value in the meantime. And that's what money is. It ends up just being the most saleable good. It's the thing that people will store up because they know other people will accept it as payment later on. So money is always, forever has been and forever will be, the thing that people accept as payment because they know other people will accept it as payment. That is the definition of money. In other words, it's the most saleable good. So that the characteristics of gold have led it to become that. Again, it's not intrinsically valuable because if you are stranded on a desert island, it's not intrinsically valuable to you. You would prefer to have something else instead. Bitcoin also, it's a software. It has different characteristics, specific characteristics that in a digital world, it operates very similar to the way gold does in a physical world. And so some people have said, okay, well, I want to have some of that because I believe other people in the future will accept it as payment. It's the same thing. Now they could be wrong or right about that, but it's still just a payment system. It is a piece of software. It is a ledger. It is a monetary technology that characteristically in a digital world looks very similar to the way gold operates. And so again, they could be right or wrong about that, but it's the same thing as like, okay, you look at PayPal. It's like PayPal is a payments network, and people ascribe value to it because payment networks are valuable. It happens to move dollars back and forth. Bitcoin is a payment network that happens to move Bitcoin back and forth. But again, very similar things going on here, and that's why people would ascribe value to it. So it's all just subjective, and people could be wrong or right about the future price of something, but there's no fundamental or quality of anything called intrinsic value that exists in real life. Looks like the adults in the room are starting to take over. Amazon and Google are making AI chips, long-term NVIDIA going back to graphics cards for the majority of their revenue. Yeah, I mean, and also like Tesla too. Musk recently came out and said that he doesn't see any possible future where they can get the chips they need without manufacturing them themselves. That is one of the biggest bottlenecks right now. And so there's always going to be a market leader in everything. It's not like there's never been a world where everybody's just like, well, we're just going to make everything we need ourselves. It's like relative what's the word? The Schumpeter relative advantage has always existed. It's like the thing, if I do one thing better than everybody else, I'm going to command a market premium for that. Um, it's the reason why like lawyers hire, $50 an hour typists. It's like, yes, the lawyer might be able to type faster, but because he can do other work instead that's worth $300, $400, $500 an hour, it's worth it to pay somebody else to do a job worse and slower than he can because it frees up his time to do something else. So it's like there's always going to be a place in the market for the market leader that can command a premium for something, even if other people could or other companies could do it for themselves and sometimes do with, for certain things. That doesn't necessarily mean that the market leader for something is just going to evaporate from existence or not have any demand. That's not the way it works. Should I take my money out of Chase Bank? If so, how should I bank? Well, I can't tell you whether you should or shouldn't. I personally don't like any of the big banks. I think Wells Fargo is the bank for people who hate themselves. Bank of America is the bank for people who really enjoy uh, really enjoy having a tough time with technology. And then Chase, just people think is like the default choice, where it's like, okay, if I don't have Chase, like that's the bank. Like, where else am I going to bank? The reality is there are plenty of banks or fintech companies, financial technology companies that use other banks as custodians that offer way better service, way better pricing, way better features, higher interest on checking and savings, um, better technology, user interface, customer service, all of that. There's an infinite number of options out there. Kind of a cheat code or a hack is to use a company that doesn't do banking as their primary moneymaker, that they offer it as like an additional service. So many brokerages offer actual bank accounts um, that have really great services, really great features, and because they're doing it as an add-on, they're able to pay high yield savings accounts, high interest on their high yield savings accounts and things that um, others won't, because they're just trying to attract customers for their main business, like bring your 401k over, your IRA over, brokerage account, something like that. And so a lot of times you can find a lot better features, pricing, services, customer service with with things like that. Okay. SPY to all-time highs. I mean, at some point, yes, that's what happens when the money supply always goes up. Let's see. What is your 10 to 20-year outlook in the bond market? Are they still a useful tool in reducing volatility in retirement? I don't think the next 10 to 20 years is going to look the opposite of the last 40 years. From 1980 to 2020, we had a disinflationary falling interest rate environment. And so bonds were useful in a stock portfolio because over the long term, there was almost always a chance in the future to sell your bonds at a higher price or hold them to maturity and get your interest. That's what happens when you have a government that starts off, in 1980, the debt to GDP ratio was 30%. So when the government is levering up, when the money supply is expanding, then you get you get a disinflationary falling interest rate environment. That really cannot continue without. I mean, that the reason why 2020 ended that was because inflation finally broke out. So then you have to start attacking things from a different standpoint, because if you keep on just doing what you were doing before, then you have inflation just destroy the currency. You have to borrow more to cover all of your expenses, and it's a hyperinflationary spiral. So you have to start doing things to try and mitigate that. So in the same exact thing happened starting in 1945. So we're at the very similar place as we were back in the early 1940s. The debt to GDP ratio hit 120% then, it hit 120% now. So the playbook is yield curve control. The playbook is the central bank stepping in and monetizing a lot of that debt. The government has to deleverage compared to the size of the economy. And so we are going to see a lot more we're going to see things like bank deregulation help the banks do QE. We're going to see the Fed probably step in to do some sort of yield curve control. We're going to see prices go up for a long time, just like they did from the 40s to the 80s. We're going to see interest rates go up during that time for everybody to compensate for that inflation, everybody except the government. And so we're in a period of time that will look, in my opinion, a lot more similar to that. It's the kind of the 40-year debt cycle, not exactly 40 years, but roughly. And the reality is, if they don't use that same playbook, which they've recently started talking about more and more, then you either get hyperinflation or deflationary death spiral. If you want to thread the needle between those two things, then you have to use those same playbooks, which means higher prices for individuals and corporations, higher interest rates for individuals and corporations, and falling bond prices, higher inflation. Oh, and then the decreasing government debt to GDP ratio. Is Eli Lilly curing cancer now? Gotta love these clown analysts with their upgrades. Follow them and you'll get crushed. These are the same clowns that slapped upgrades on APP, RDDT, CVNA at highs. Eli Lilly has a massive, and I'm not going to share my screen with you because every time I do that, I start getting a bunch of comments that I've frozen up and glitched. So if you guys have a chart in front of you, the symbol is LLY. Look at LLY over the past, 15 years. And what you'll see here is one of the biggest, best, most massive bull flag formations you've ever seen. It looks better on a monthly chart where each candle is 1 month, but it is just a phenomenal setup. Technically speaking, from a chart perspective, it is just a absolutely beautiful chart here. As soon as we broke out of the that upper trend line on the flag, we came back down, retested, bounced straight off of it, and since that bounce, Eli Lilly is up 36% in less than 1 month, just under 1 month. So just a beautiful chart from a chart perspective. The second thing is that whole consolidation correction time period that lasted from March of maybe like July of 2024 was when they peaked before they started moving down. That whole correction period, they were having a lot of kind of like legal things back and forth with, Ozempic and I can't remember what their named ones are called, but they're the GLP-1s in the second generation. Like I think Mounjaro might be theirs, or tirzepatide. Either way, they had a lot of issues with that because these things are very easy to manufacture. And so they're trying to go back and forth with like the FDA to get reclassification so that they can patent them, so that they can come after some of these smaller pharmacies or overseas companies that are just manufacturing them anyway, and charging way less because black markets are free markets. And so anyway, that was part of the big reason why they were falling there. And a lot of that is kind of past now. And I think they've just announced they're going to be lowering prices as well. I think that's just because they know they've got to compete. People would rather get it from these companies that they know are making it cleanly and professionally, and they're not making it in factories that are making fentanyl in China. Like there's people would prefer to get them from the legit sources. But if it's like, okay, well, I can get it for a tenth of the cost or 1/100th of the cost, then yeah, I might roll the dice a little bit. So I think that's part of the reason It's part of the fundamental reasons why Eli Lilly has just been crushing it over the last month. 9 a.m. is early. Yeah, I know that. I'm West Coast. Yeah, so that's why. All right. Who do you think will be the biggest beneficiary of the autonomous vehicle race? Tesla with their existing ready to convert fleet, or Waymo and Google with their slower, more methodical? I mean, you don't have to choose. Like, you can be long both. Like, you can be long a portfolio of self-driving, robotic car stocks. So that would include like Google, um, Tesla. Uber would be a big beneficiary of it, because when they finally replace all of their, like, most of the money they make goes to paying drivers. And so if and when they replace drivers, that's mostly just profit for them. So Uber will be a big beneficiary. There are some other companies, smaller companies, like there's one called Aurora that does self-driving tech for internal combustion vehicles. So they're one of, if not the only ones that do that for regular gas engine. I think it's trucks right now, versus just doing it on electric. Um, but in terms of, if you're just wondering which one I think is going to be better, it's like Waymo has a lot more tech that makes it potentially better right now, but the scalability of that is very limited because it's so much more expensive to for Waymo to build those and roll them out, versus Tesla's approach of going optical only, going video only, is like, okay, we basically have to solve AGI because that's what humans do. We're constantly taking in visual information and processing it in our brains to make those driving decisions. And so Tesla's taken that like much slower approach of like, okay, we're going to limit the input of data, and that means we have to solve the brain issue on the back end. Once they do that, though, it's like the cost to roll that out is basically nothing comparatively. So I think Waymo is a better like initial plan, but worse long term. And Tesla is the opposite. But we'll see, because it's this. I mean, this is why the free markets are so great, because you have a lot of money on the line and a lot of research and a lot of incentives on both sides to make both work. And it's like one or maybe both will work, but you don't have to choose. You don't have to get a big vote together and force the country to all do one thing and just hope it works out. So anyway, okay, let's see. Where's the next question? I really enjoyed your last video. How long until Trump makes the Fed less political and powerful? I think the opposite is happening right now. That I mean, he's stacking the leadership there in a way that is currently aligned with the executive branches, with the White House administration's like current goals. And part of that is just because, like, okay, Powell's retiring. So it's like, that's not, nothing that he's doing intentionally for that. I mean, he was trying, because he was trying to find a way to fire Powell. And then there's other ways where he's actually, they're going in specifically. And I mean, they dug up dirt on every single member of the FOMC just to try and find like something. Somebody discovered that what was her name? Was it Kugler? That had 2 mortgage applications during the same time where she said it was her primary residence. And they're like, all right, we're going to fire you. And I don't think that's gone to the Supreme Court yet. I think it's almost there, or it's happening soon. But so it's like, it's very clear that it's like we're removing the political independence of the Federal Reserve and putting in people that are currently going to do what, the executive branch wants. And if that doesn't work, I mean, this is probably would have to be Congress, but the Federal Reserve at some point will look just like an extension of the Treasury, um, which I think is much like, if you don't like an independent Fed, and I know when you say independent, it's like it's independent of like party influence. That's the way that's what they mean by independence. Obviously, they are there to make sure the government can keep on, not defaulting. That's their goal. So they are not politically independent in the sense that they're there to serve the government. They exist because of the Federal Reserve Act, and their jobs are given to them by the Federal Reserve Act amendments. And at any point, the government can say, okay, you either now fall underneath the Treasury, you're folded into the Treasury, you no longer exist, you have different mandates, whatever. Um, but I think over the past years, we've seen a definite trend towards less independence and more influence from the administration, from the executive branch. We have not seen less of that, and I think that's a dangerous trend because it's whoever is in the White House controls monetary policy as well. It's that's if you don't like an independent Fed, you won't like an executive branch Fed. Try OBS for live stream. All right, I'll try that next time. Let's see. Market is historically high valuations, which indicates limited upside. Economy has signs of low growth. Time for dividends. It's always time for dividends. There's always a good place in your portfolio for high dividend, paying stocks. So I wouldn't look at high dividend paying stocks as something that you move towards if you're like afraid of what the market is going to do, because ultimately the goal of investing is to maximize long-term wealth. So everything that people say about investing, like, oh, you want low volatility, you want, if you're nearing retirement, or you want income, it's like, no, you're trying to maximize your wealth. And so the underlying assumptions there are that, like, oh, well, if I'm in a growth portfolio, then they could crash when I need them, and then I'm selling them at a discount, which means I have less wealth. It's like, okay, the ultimate goal then is to have the most amount of wealth. And so whether that results from you selling shares of a high growth stock that's performing really well, or receiving income from a stock that's paying you a dividend. Now, the other side is market is historically high valuations. It's like, yeah, valuation of the overall market, the indexes on average are historically high. And typically when we get this high, forward returns for the next, decade or so are in between -2% and 2%. The issue is all of that data deals with a history where we have not been in the type of monetary and fiscal environment we're in right now. We have not been in a place where we're going to have to see yield curve control, where we're going to have to see the government deleveraging its debt to GDP ratio, where we're going to see quantitative easing at the scale, or yield curve control at this scale, or bank deregulation for stealth QE at this scale. We've not the future of dollar debasement that's being priced into assets is why we have these high valuations. And that dollar debasement justifies those higher valuations, because the more inflation you have into the future and the expectations of that, the higher prices you're willing to pay for those assets, because at least it's still better than just keeping in cash. It's definitely better than bonds, which will probably pay a negative return for the next 10, 20 years after inflation. All right. Jonathan, thank you so much for the super chat. I really appreciate. I will enjoy a coffee on you. Thank you so much. Any SVXY puts worth considering as a hedge right now? I like to pick up volatility hedges when the VIX is historically like really low. And we've come back down from where we were. The VIX right now is under 19. And a couple of days ago, it was above 25. But when I say low, I mean the 14, 13. When it gets that low, then it's like, okay, you pick up some out of the money puts on something like SVXY. Number one, they're going to be super cheap. And number two, you get a big enough spike in the VIX afterwards, you can get failure in funds like SVXY and all long volatility funds, even if they have, short volatility funds, even if they have long volatility hedges built into them. 9 times out of 10, it's not enough. And just the bleeding alone over time from a higher volatility environment then can potentially make your puts worth more. So right now, timing wise, we're probably getting close. I'm not currently adding any volatility, long volatility trades right now, but we're probably getting close. I like to do it when volatility is a little lower. Thoughts on large cap growth? High unemployment, unclear AI revenue, still a little worrying. I'm still bullish on large cap growth. Yeah, I'm currently very bullish long term on large cap growth, especially some like the Mag 7 names. I mean, when Berkshire Hathaway puts money into a stock at an all-time high, usually that's not an indication that that entire sector is about to pop, is a bubble, is about to crash. Usually that's a sign that, hey, we might be missing something here, and there might be a big leg up. I mean, remember when Buffett invested a bunch in Apple? It's been a huge chunk of all Berkshire Hathaway's profits, their returns over the last decade. All right, let's see. Navy Federal Credit Union, they refund ATM fees. I mean, number one, most people I don't think are using ATMs a lot these days, but if you are and you're paying ATM fees, then you're probably banking somewhere you shouldn't be. There are so many now that will refund all ATM fees, that will refund all foreign transaction fees, anything like that. And like if you're paying a fee to have a bank account, it's like those are all signs that you're doing something wrong. All right, about to inherit 400,000 after paying off a $180,000 mortgage. I'll have 220,000 left. How should I invest? Well, first of all, congratulations. I mean, also condolences. I guess it depends on who you're inheriting it from. But the first question I would ask is, why are you paying off the mortgage? The reason I ask that is because most people who have a mortgage right now have a rate that's under 4%. And so if you can invest that for 5%, if you can invest it for 6%, if you put it in the market and after inflation return 8%, it's like you can do mental accounting and have a paid off mortgage because that portfolio is paying your mortgage payment for you. And you keep the difference, you keep the spread. So as you pay down that mortgage with the proceeds from the investing, your portfolio is going to keep on growing, and the amount you're paying in interest dollar wise is going to keep on decreasing. And so I would play around, plug it into let me see if I think I have a link for you guys for a really good. Oh no, that's owning versus renting calculator. Just Google mortgage payoff calculator, mortgage payoff versus investing calculator. And you'll probably have to play around with a couple of them, but just look at what the difference in your wealth will be over the next 10, 15, 20 years. Because that'll probably help you make up your mind about that. And if you have a mortgage, it's like, 6 or 7%, then that's a completely different story, because then the difference from investing, especially, if we don't get, 11, 12, 13% returns in the market, then the difference is going to be a lot less. And so then the risk is a lot higher. But with the rest of it, I tend to point people towards what I call my bulletproof portfolio. It is a twist on the standard 60-40 portfolio and a really old portfolio called the Talmud portfolio. So this is a portfolio that people have been using for at least 1,500 years to preserve their wealth. And if you put about a third in real estate, a third in stocks, and a third in savings or reserves. Now, historically, up until 1971, that savings or reserves always meant gold. So the way that I break it down is a little bit more nuanced. I'll have about 20% in gold, 5% in Bitcoin, 5% in cash and cash equivalents, 30% in stocks, 30% in real estate, and then 10% for trading, speculation, asymmetric trades, that kind of thing. And then the stocks portion, you can do index funds if you'd like to make it easy, simple, diversified. You can pick individual stocks if you'd like. Just make sure that if you're going to pick an individual stock, it's one that you'd be comfortable owning for the next 30, 40 years if you could not trade it again. If you could not sell it, the market shut off. And the next time you'd be able to touch it would be, let's say 30, 40 years from now. That'll keep you away from most get rich quick, potential pump and dump or crashes or that kind of thing. You'll have to kind of narrow it down for some quality. All right, let's see. You aren't using OBS for live streams. You're only smalls. No, I'm just using Google. I open up Google Chrome, go to YouTube Studio, click go live. So that's probably the issue here. I'm using just Google Chrome. So OBS, I believe I would be using OBS as my webcam. And then inside of OBS, I would be switching back and forth between like sharing the screen and the camera view and that sort of thing, as far as I understand it. I just haven't ever set it up. So, okay, let's see here. Maximize wealth equals added risk. This is another misconception. It's like what you're saying is that you don't want your wealth to be lower. When you're saying, okay, well, I want to eliminate or reduce my risk, it's like, yes, that it means you want to maximize your wealth. It's a misunderstanding of the terms. So the reason why people always get this wrong is because they think risk equals volatility. Risk is not volatility. In fact, some of the things with the lowest volatility have had the highest amount of risk that's just hidden from the market. So when you look at something like the dollar value of gold was the least volatile thing for decades because it was held there by law. And it turns out they were printing way too many dollars and the true value was different than the legally held value. And when it finally broke the peg, the volatility exploded and the value of the dollar crashed against gold. And so many times, oftentimes, the least volatile things are actually risk that is being hidden or suppressed. And eventually that risk blows up and expresses itself, which also means on the opposite side, sometimes the most volatile assets are volatile, showing you what the true market pricing is, what the price discovery is. It's showing you what the true risk is, because that volatility is able to be expressed by all market participants through their buying and selling and potential buying and selling. And so the proper way to define risk is what is the worst case scenario. So when you buy a stock, the worst case scenario is it goes to zero. Actually, if you buy a stock, the worst case scenario is it shuts down and has to liquidate its assets and then pay off its debt, and anything left over it returns to shareholders. So this is like the old Benjamin Graham style of investing after the Great Depression. He's like, there's tons of companies you can pick up that are like, they have no, they have no risk in them, because worst case scenario, the company shuts down. They sell off all their assets. They pay back debt holders, their lenders, and they have money left over to pay back their shareholders that is worth more than what the current shares cost. And so in that case, it's like worst case scenario is I get my money back that I invested plus a little bit, or maybe I get back a little bit less than I invested. So risk equals what is the worst thing that could happen. And once you identify risk properly like that, then you can actually take steps to mitigate your risk. For instance, if you buy puts on a stock, now you have a defined risk of the floor of what that portfolio can be worth, because in that amount of time frame, your worst case scenario can't go below that. You have a guaranteed option to be able to sell your shares at a specific price during that time frame. And so once you identify risk properly, you can actually mitigate risk, which means, and by risk, I mean the worst case scenario, you can remove or reduce worst case scenario. That means then that you can take on more traditionally defined risk. In other words, invest in things that have higher potential upside because you know how to actually reduce your downside. Reducing downside, putting a floor underneath your assets, allows you to expose yourself to more explosive upside. Many people take a look at that and say, well, that's risky. It's like, well, you don't understand risk. And so at the end of the day, the only thing anybody actually really cares about is maximizing wealth. When you conflate it with risk, all you're doing is misunderstanding what the word actually means. All right, let's see here. Um, Stocks AVGO, ANET, and VRT. AVGO is Broadcom. I like it. I'm bullish. I don't know if I'm long. I might have a little bit of Broadcom right now. I don't know. We did have a trade on it in my trading program a while ago. Turned out very well. I don't remember if I still have any. ANET, I don't know that stock. Let's see. ANET. Arista Networks. Chart looks good. Good pullback here. Good bounce off some weak support. Could potentially have some more downside just based on the chart. Computer peripherals, electronic technology. So not super great valuation. Market cap is 157 billion, so it's pretty big. Yeah, other than that, I don't really know anything about that company, so can't give more thoughts there. VRT, I am long, bullish. I like it. Massive upside down, head and shoulders breakout. Strong breakout and retest and holding above support now. I am currently long and bullish on VRT. You think this is the fake out in the market? I've been bearish on the market lately, but I'm undecided. I don't think it's a fake out. Well, it depends on what you mean by fake out, which direction you're talking about. My base case is bullish. Um, and so I think corrections and volatility are normal to happen in a bullish environment. Markets climb a wall of worry, they go up the escalator, go down the elevator, and that's what happens in bull markets. So a 4% pullback in the midst of a long bull market that is currently right on trend. It's not above trend, it's right on trend since the bottom of the big bear market in 2022. I'm not convinced this is the beginning of a big downward spiral. It could be, but it doesn't look that way to me. This stream is great. It's going places. Well, thank you, Orthodox NPC. Appreciate it. Any ideas on Pfizer? Sorry if I already covered. I did not cover Pfizer already. I don't like Pfizer. So, like even like Eli Lilly, I tend to not invest in companies that I really dislike for any reason. Like if I dislike their customer service or I dislike their products or I dislike their leadership, like Mark Mark Benoit, the Salesforce guy. I don't remember how you say his name. Benoit. The stock symbol is CRM. It's probably a company that's going to do well, but I don't like the product and I really dislike the leadership of the company. I think that, yeah, I'll leave it. I'll leave it there. And so for that reason, I don't have much confidence that a trend might hold intact, like just because it's been performing well, that it will continue. Because it's like, well, if the company is doing things that are pissing off its customers, that are making people dislike them, that are doing things that I believe are inherently immoral or lack integrity, long term, I think that's going to damage the business and it will result in the company not doing well. So there are lots of things that, in my opinion, companies like Pfizer do that kind of match that description. Technically speaking, it is currently testing a long-term support and resistance line. It looks like they've got kind of a bear flag going on. So just the chart alone, I'd be cautious, but I might be willing to take out a short position. I don't have any position on Pfizer right now. The chart looks bearish to me, but I'd be very careful because it's been going down for a long time. So you have room for a big relief rally. So, but long term, I tend to stay away from investing in companies that I fundamentally really dislike, like internet service providers that only have business because they have legal monopolies on being able to provide that. And then once the free market finds a way around that, like things like um, Starlink and Amazon's coming out with one called Leo. It's like those companies are doomed. If you have a really terrible product, really terrible leadership, really terrible culture, really terrible customer service, but you're able to stay in business because the government has prevented competition, it's like once the free market finds a way around that, you are done. All right. Are those black boxes on your VOD desk all monitors? No, those are lights. Here, let me do it this way. So that is where I record my YouTube videos. So oh man, it's gonna be blurry. There we go. There we go. So those are lights, and that is a light. There's a monitor back there, cameras back there. As you can see, it's a very, very unsophisticated, unprofessional looking setup back there. And what you'll find is most YouTube studios are like that. It's just like wires and cameras and jerry rigged stuff and popsicle sticks and bubblegum holding things together. It's like, all right, the equipment, this setup works. And then everything that's in the camera view on that side looks like normal and nice, but that's just I've got poles going across and things hanging off of there, and so no, they're not all monitors. 40-year derivative trader, appreciate your content. Well, thank you, Charles. I appreciate that. Do you use trailing stop losses, and if so, how? The majority of my trading, not my long-term investing, but the majority of my trading is using options. So I definitely do not use any sort of stop order at all, because that would trigger a market order for a regular trailing stop or stop. And you don't want to use a market order when you're trading options, because the wide bid-ask spread, you're going to get killed on the fill. I also don't use stop limit orders, because when the stop gets triggered, you don't know where the market will be. So you don't know if your limit order will be, near the mid. You don't know if it'll be, immediately triggered at a terrible fill. You don't know if it'll just sit there and not get filled. And so I don't use stops, trailing, stop limit, anything like that for my trading. On my long-term portfolio of just like, long-term stocks that I hold, I typically don't do that either, because those are, when those high quality companies that I'm holding for 10, 20, 30 years have a pullback, those are the times when I'm buying more through just dollar cost averaging or maybe some rebalancing. So I tend to personally not use them. Now, it doesn't mean I don't recommend using them, because I do. I think it's very important to have a method of risk management. Um, no matter what, you need to have a defined exit on the loss side. And the easiest way for most people to do that is through things like trailing stops or stop limits. Um, I also don't need to do that, because I'm watching the markets all day, every day. So when something happens and something starts to move, I'm aware of it. I typically am not in a position where I would need that to happen automatically. All right. Let's see here. You often share in your videos how laws change the behavior of people from their free will. Where's the Goldilocks line between anarchy and dictatorship for a free and just society? Um, Dictatorship is tyranny by one, or tyranny by the military. Democracy is tyranny by the majority. A republic is tyranny by the minority. An oligarchy is tyranny by the wealthy and politically connected. A gerontocracy is tyranny by the old. Kleptocracy is tyranny by the thieves. All forms of government inherently, by definition, because of what the government does, are just different forms of tyranny. Because a government, by definition, to boil it down to a definitive box around it with lines in the sand that are not arbitrary, a government is a monopoly on violence. That's it. regardless of the size. And so if there is no choice involved, like you cannot leave, there's no freedom to opt out of the system, and they use force, in other words, violence, men with guns, put you in prison, in order to enforce things and prevent you from opting out and prevent you from leaving, then again, it's tyranny in one form or another. And so the only just system is one without tyranny, without anybody exercising monopoly on violence, without any force violating rights. Now, when people hear that, they think, okay, well, if you have a system with just anarchy, then it's just ruled by mob and ruled by the strongest person with the strongest gun. It's like, okay, in our definitions that we've talked about here, that means then that you're defaulting to a government. So people, without realizing it, will say, okay, in order to prevent somebody from rising to power and exercising their will over everybody else through force and violence, we need to put somebody in power that exercises their will on everybody else, enforcing it through force and violence. um, and the other thing is, just because you have anarchy, in the sense that I'm talking about, doesn't mean you don't have defense. In fact, defense of your property and your rights is 1,000% moral and integral into an anarchical system. The only thing that doesn't happen in anarchy is the violation of other people's property rights. Once you have an entity that can violate rights, then you no longer have anarchy. You have a government. I would recommend reading The Ethics of Anarcho-Capitalism for more thoughts on that. So in other words, I don't think there is a Goldilocks, a middle ground. It's like, what's the best amount of tyranny? I think probably no tyranny. All right. I'm looking to set up an investment account for my son who is 8 months old. I want it to be something he has access to when he's 18 and only he has access to withdraw. Any advice? Yeah, for that, what you're describing, that would just be a custodial brokerage account. So there are different types of accounts for children. A lot of them are education based. And so one of them would be a 529 plan. One of them would be an educational savings account. Sometimes they're called educational IRAs. But those, you put the money in and it can be invested and it grows, and then the kid can take it out or use it for educational purposes. Between those two, I tend to prefer the ESA because you have more control over it. I prefer that over the 529. You have more control over it. If the kid ends up not going to college or something, you can assign it to a different beneficiary. You maintain control of it for a long time. If they want to use it for something other than education, then they just pay taxes on it. So it's a lot more flexible. Now, it has low contribution limits, again, for educational purposes only. So if you want a little bit more freedom, then what you're describing there would be a custodial brokerage account. And it's called a custodial account because it needs a custodian to manage the money until they turn age of majority, which in this case would probably be you. And so you put money in, or they put money in if they have, earned income from something. They can put that money in. Anybody can put money in it for them. You manage the investments in it. Here's the risk, though. They can and they can use the money for anything once, they can take it out all at once. It's just a brokerage account for them at that point. The risk is if something terrible happens in the way that your kid turns out. For instance, I've talked to people who, they're like, hey, I've got this, brokerage account. It's a custodial account for my kid. He's turning 18 in 3 months. And he got hooked on drugs a couple months ago. He's out on the streets. Like, he's just, his life is an absolute wreck right now. And there's, $200,000 in this brokerage account because I've invested it well. If he gets access to this, he will kill himself. Like, he will overdose. He will just, it will ruin his life, where he will kill himself. What can I do to make sure he can't get access to it? And the answer is nothing. Legally, the money is his. In fact, the day he turns 18, you will not even be able to access the account. You won't be able to see it. You won't be able to invest in it. You won't be able to touch it. You won't be able to call the broker and ask questions about it. It's not yours. Legally, the money belongs to the kid. And as far as like the standard procedure is, they will be notified of it as well. Like, hey, you need to come, get access to this and start making decisions on it. So that's the big risk. If you feel like you can prevent that and mitigate that risk, and that you're going to do the as much as is possible to control for some sort of outcome like that, then a custodial brokerage account is probably the thing that you are looking for there. Just be aware, as soon as the money goes into that account, it legally belongs to the kid. You cannot take it back out. You cannot put it in your own account. You cannot spend that money on yourself. You cannot transfer it to another one of your accounts. The money belongs to the kid. Okay. About the mortgage calculator, didn't we say the S&P has a very high valuation and it's not impossible to get a 2 to 3% compounding annual growth rate over the next 10 years? Well, I did talk about that, but that was not the conclusion that I was saying. So historically, when valuations over the overall market are this high, historically, that means that the forward, 10-year returns are somewhere between -2 and 2%, in that range. The problem is all of that data has happened during like normal monetary environments. When you look at places where they have, like on the extreme example, when they do like go through like hyperinflation, it's like stocks go through the roof because everybody's protecting their assets from that inflation. So the environment that we're in right now actually justifies those higher valuations because of the debasement that everybody is expecting. And that means that you can still have fantastic nominal returns, despite the fact that we haven't had that in recent history when valuations get here. In other words, the more debasement you have, the higher valuations are justified, not necessarily indicative of low future returns. Love your short show, Joe. Thank you so much. Appreciate that. Will NVIDIA make it to green today? Well, I'm assuming that you placed that comment before 6 minutes ago. NVIDIA closed at $177.79. That means it closed 2.6% down on the day. I'm not that concerned about day-to-day movements like that. NVIDIA had a huge move up, and so they've been consolidating since July. It's a couple of months volatile, moving sideways. Not really a huge deal. The S&P 500 did close up almost 1%. Let's see, it closed up 0.9%. NASDAQ closed up 0.75%. The Dow closed up 1.4%. And small caps, the Russell 2000 closed 2.14% up. So the indexes overall closing strong, breaking out above a little bit of resistance there, closing above it. And so looks like the worst of the correction is potentially over here. If I purchased a long leap on a dividend stock and I exercise it at expiration, do I collect the dividends that have taken place during that leap, or with the dividends only kick in once I exercise? Yeah, if you don't own the shares, you don't get the dividend. If you're short shares, you actually have to pay the dividend. Most people don't know that. If you short sell a stock and it pays a dividend during that time, then your account actually gets charged for that dividend. And so you have to own the shares prior to it's called the ex-dividend date. It's a couple days before the dividend gets paid. You have to own the shares before that and through that date in order to be entitled to get the dividend. I'm at 68. Do I still use the Talmud portfolio? I mean, personally, I would just adjust the percentages. So, and adjust it depending on your expertise as well. Like if you've never invested in real estate before, then it's probably not the greatest idea to start that at this point, just because, like there's nothing wrong with doing what you know and focusing on what you know. So you may just have to get a little bit better diversification or access to that exposure to that sector through your stock portfolio, with things like home builders and stuff. But yeah, personally, you just adjust the overall allocation so that you're a little bit more conservative instead of as aggressive. Let's see. Can one use a tax preferred IRA to roll over a pension? Um, Pensions usually have a buyout or rollover amount. And so you would have to contact the pension administrator to figure out what that amount is. It tends to be fairly low, but usually that's an option where you can take a lump sum distribution, which would end your pension, but that would then roll over into a traditional IRA. How about that 45-year cup and handle basing on silver possibly breaking out? Um, so for things like a cup and handle, you want the chart and the technical formation that you're watching and looking for to be commensurate with the time frame that you're looking at. And so if you're looking at a 45-year chart, then you'd be looking at, I'm assuming, the 1980 or 1979, the 1980 peak through the 2011 peak, and then that would be the cup, and then the handle would be from 2011 through 2020-ish. The way that you would want to look at that then would be like a monthly candle chart. Now, to be honest, it's not the prettiest. like it's not what I would call a textbook cup and handle in terms of the way it looks, but I mean it's close enough where I would I would still call it that. And then we have a really really nice rally starting in May of 2020 from the bottom of that handle. So we have broken out above the high from 1980. We've broken out above the high from 2011, and now, because those are such long time frames, what you tend to see is consolidation. You tend to see like a lot of profit taking. You tend to see a lot of volatility where things get sold off. See if the market comes back in and can hold that old resistance as new support. And so that's what we've been seeing since, I don't know, for the last month and a half, which is really not long at all. The reason why I'm saying that is because I would not be surprised at all to see a lot more volatility for a lot longer here, just given the fact that this was such a big move over a short amount of time relative to when this pattern has been forming. That being said, I am long-term bullish on silver. I just think that the expectations that a lot of long-term silver holders have, that it's going to do, 100, 150, 200, $300 per ounce within the next couple of years, I think it's probably pretty unlikely. And that we might have more sideways action than a lot of people are hoping for. All right, let's see. Do libertarians hate age of consent laws? That is a good question. I mean, I don't. and 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 so I don't know if this is the proper libertarian or anarchist point of view on this. I don't think, like, you have to ask a question like, what does it mean to be able to consent? And I don't think, if you're a child, like if your brain is not fully formed, like I don't think you can consent to a lot of things. So there, I think it's probably a bit of a straw man to say like, oh, if you believe in anarchy, like you believe that like, adults should be able to be with children and stuff like that. I don't think that is an accurate view, because you need consent in order to be able to not violate somebody's rights. And if somebody is not able to provide consent, then you're by definition violating their rights. So that's just my initial thoughts on that topic. I'm not I actually don't know the typical arguments for or against that from the extreme libertarian or anarcho-capitalist crowd. But that would be my guess as to how most people would probably think through that. At least that's my initial thoughts. All right, let's see. Next question here. Within 6 months, do you see Bitcoin reaching a new all-time high? Um, I'll give you my truthful answer first, which is I don't know and I don't care. Because I allocated 5% of my net worth to Bitcoin in 2020, according to my portfolio allocation recommendation. And I allocate 5% of my new invested money into Bitcoin continuously. So I've been dollar cost averaging. I buy every day because I like taking advantage of the extra volatility that Bitcoin has and buying more on those big red days. And so, like, to me, like, I'm long-term bullish on Bitcoin. I think it will probably do very well in the long-term future. And so, like, the longer it takes to hit all-time highs, I think the better, because it gives you more. Like, that's why it never bothered me that I thought gold was undervalued. And I was like, I know, like, you look at my original videos on YouTube, it's like I was talking about buying gold a ton, because I'm like, that it just it's got to go up quite a bit from here. And the longer it takes, the more I can buy of it. So, um, what I would guess is within the next 6 months, I think there's a pretty good likelihood that we see a new all-time high, but I'm not banking on it. What do you see home interest rates doing in the next 10 years? I think that we'll probably get a short-term period of time within the next year or so where interest rates are going to be lower, which will give a lot of people the ability to sell and move and buy something else. Because a lot of supply is locked right now because nobody can afford to move, because the new place, the new mortgage, the new rent would be much more than what they're locked in at right now. So that will allow a lot of people to start moving and refinancing and all that. The long term, though, I think that's going to be a very short lived environment, because inflation is going to be picking back up again, probably pretty strongly. And so, in my opinion, the only way mortgage rates stay low is if they get pegged there by law. Like if there's some sort of executive action or congressional action or something like that that does something similar to mortgages that we've seen them, interfere in, like the student loans, that type of thing, where it's like, all right, mortgages can't be over this percent, and it's like, well, figure out a way to fund that or backstop the lenders or whatever it is, which I think would be very bad if they did that. But I would not put it past our government to do something like that. All right, let's see. What do you think can crash the stock market? Well, one thing is if we actually get any sort of a movement towards fiscal responsibility, because a lot of the money flooding into the stock market is doing so because it's a way to protect your money from debasement, and B, it's like all the slow rise in the money supply and liquidity. Um, it justifies higher valuations, pushes prices up, increases revenues and profits. That increases higher valuations. It's like a rising tide that lifts all boats. And so fiscal responsibility, smaller deficit, the debt increasing by a much smaller amount. All those things would mean there's less free money sloshing around in the system. That triggers some very large deflationary events. You can get widespread defaults. You can get zombie companies shutting down, things like that. And ultimately, that's very healthy for an economy to get all that dead wood burned out of the forest, so to speak. But in the short term, it's like it's still a fire. In the short term, it's still painful. And so I think that that could definitely be something. I just don't think that that is even remotely probable. Um, but that is one thing. All right, let's see here. Is Fed Now still a thing, and is it actually charging banks 4 cents per transaction? Please and thank you. Yes, Fed Now is a thing. I haven't looked at it in a long time. What is it doing? Fed Now. You can go to explore.fednow.org. 1,500 participants strong. So it's kind of like the plumbing for a CBDC. It's an instant payments infrastructure that allows banks to send and receive transactions within seconds on behalf of their customers. I believe Fed Now is the backbone behind that Zelle is built on. I could be wrong about that. So it's why with a lot of bank transactions now, even on ACH transfers, you're seeing them happen same day. Whereas it used to be, 5-10 years ago, an ACH would take 3-4 days to show up in the other account. The only way you could get a same day transfer would be like a wire. And those would cost, $35 for that because the wires then have to go through the Fed. So it's kind of like the base layer transaction. Like it's a lot like Bitcoin is a lot like the dollar. It's like if you want to move money on chain with Bitcoin, um, it's costly. It takes a long time, and but it's recorded on the blockchain. Versus if you use like second layer or third layer transactions that are built on top of that, it's cheap or free, almost instantaneous. Maybe it doesn't settle immediately behind the scenes, kind of like checks or debit cards, that kind of thing. They can have longer settlement times. So anyway, it's still a thing. I don't think there's anything to be scared about with Fed Now right now. All right, we'll do one more question here because we've been going for an hour and 20 minutes now. Let's see here. Oh, good question. I like that one. Okay, what happens to the money in circulation if the markets crash? Don't you think if 10% of stocks are sold, the entire market will crash much more than 50%? Okay, so the first part of the question is what happens to money in circulation when something crashes? This is another like fundamental misunderstanding that a lot of people have with markets. They say, oh, Bitcoin is, all the money is flowing into Bitcoin, or all the money is flowing into real estate, or all the money is flowing into these stocks. Like the money isn't flowing into anything. When you buy a stock, dollars leave your brokerage account and they go into the brokerage account of the person who sold you those shares. So the number of dollars in the system stayed the exact same. It didn't change. $100 left your brokerage account, $100 entered their brokerage account. When you sell a stock, same thing. You're selling a stock, $1,000 leaves the buyer's brokerage account and ends up in your brokerage account. So the number of dollars stays the same. The difference is what are the buyers and sellers willing to buy and sell those shares at? And so your perceived value might change because you're like, oh, well, I'm only willing to sell this stock for $2,000 now. But the number of dollars in the system actually stays the same. So, and that's true of all non-debt transactions. So when you use a debit card at the grocery store, dollars leave your bank account and go into the bank account of the grocery store. The number of dollars stays the same. When you buy a house with cash, it's non-debt transaction. Dollars leave your bank account and go into the bank account of the home seller. And obviously some of those dollars will go into the other bank accounts of like the the title company and the other anybody else that's involved. But the number of dollars stays the same. The only way the number of dollars in the system changes is when there are debt transactions, because debt is not taking dollars that were in one bank account and loaning them out, putting them into another person's bank account. they're using a person's bank account as collateral for dollars that are loaned into existence. So when debt is created, when a loan is made, those dollars, most of them, did not exist before the debt was created. Dollars are lent into existence. That's how new dollars come into existence, whether it's from the Fed or from banks. When debt is paid off, those dollars pay off that asset and cease to be in circulation then. They disappear from existence. So when debt is made, its dollars are loaned into existence. When debt is paid off, dollars are destroyed from existence. And so the fiscal responsibility that I was talking about earlier, the reason why that could cause a market crash is similar to like the Great Depression. That's like an extreme example. When there's an expansion of credit and eventually that tips over and turns into a contraction in credit, it's because debt is getting paid off or being defaulted on. That means dollars cease to exist. When dollars cease to exist to a large enough extent, that means there's just simply not enough buying pressure available to continue to support prices at their old level. Because if all my dollars cease to exist and I can't buy Google at $300 per share, and everybody else's dollars cease to exist and they can't buy Google at $300 per share, then somebody needs to sell Google. Maybe because of the only amount of dollars that still exist, maybe the next person in line can only afford to pay $150 for a share of Google. And the seller is like, okay, I'm willing to take that because at least I get $150 then. And so when you have a contraction in credit, which destroys the number of dollars in existence, that's what causes prices to collapse because there's now not enough money. It's the opposite of like inflation, more money chasing the same goods and services. It's deflation. That's why they call it a deflationary death spiral. It's less money chasing the same amount of goods and services. So anyway, that's the relationship between debt, monetary creation, destruction, and asset prices. All right. That's all, guys. Really great questions today. Thanks for hanging on. Thanks for joining this whole time. Appreciate it. And we'll see you next time.